All right, so a ton of stuff happening overseas that will absolutely affect us here at home, which is why we brought in the expert. Martin Baccardax is here in town, live in person from our London bureau.
Feet on the ground, historic site outside the New York Stock Exchange.
So good to have you here, and really important based on what's happening these days. All right, so we got to start with China. Fell the most since February. Trade, diplomatic tensions, what's going on?
The whole thing. I mean, we were waiting for this, really, weren't we? Because China's been on holiday in their Golden Week celebrations for the last 5 trading days, and even the authorities knew this was going to happen, this steep sell-off. They came in on Sunday and basically engendered some liquidity into the market by cutting a ratio for the banking sector.
Right, the reserves.
There we are. In fancy terms, what that does is it opens 110 billion US dollars of new liquidity. So the Chinese knew this was coming, and it came. We had a 4% fall for the Shanghai Composite, similar percentage declines for benchmarks all around the region, and as you say, the biggest one-day decline since February. It takes stocks to a 2.5-year low and puts all of the benchmarks within probably a day's trading of bear market territory. So this is not something to be played with at the moment, and as you've alluded to, it is all being engendered by these concerns that we have, not only of trade and tariffs and the tit-for-tat war that's been going on for months now, but the acceleration of the rhetoric. President Donald Trump talking about election meddling. We have Secretary of State Mike Pompeo, who's trading bombs with officials in Beijing about some of the other political dimensions between the two world's biggest economies, it has to be remembered. So this has now gone from simply a trade war amongst the wonkish to something a bit more political that has higher stakes.
But it kind of seems like China's getting nervous. As much as they have, fisticuffs up, it almost feels like they are starting to get nervous about this.
The second half signals are not very good for the Chinese economy, and it matters. I mean, we're talking about a growth rate that's still incredibly impressive, 6.8, 6.7% annual GDP. At that pace, China's going to overtake the United States as the world's biggest economy by 2030. That's something to think about straight away. But what you have to also remember is that if GDP were to slow down to the 6.5% level or perhaps beneath, Chinese officials have said themselves that that's kind of a Maginot line that could trigger higher unemployment and social unrest in an economy that has 1.2 billion people, and the wealth gap between the rich and the poor is growing far faster than GDP is advancing. So you're getting millions and hundreds of millions left behind from the growth story, which is largely taking place along the coastal cities. That's a really dangerous and potent cocktail. So I think this is why you're seeing some of that sense of nervousness. Whether they're going to wait through to the midterm elections here in the United States remains to be seen, but that market concern is going to ripple through, I believe, for several weeks.
Speaking of rippling through, then we head over to Europe. Now, while Greece still has higher yields than Italy, Italy is right there.
They're chasing.
I mean, it's what, the 10-year was 3.58, that's the highest it's been in 5 years. Italy actually seems like it's kind of in dire straits.
It's really bad at the moment, but this could be some of the brinksmanship between today and next week, when Italy has to file their formal 2019 budget to the European Commission. So there could be some trade-off at the moment between the rhetoric and the reality. But nonetheless, Italy's going to be borrowing billions of dollars more over the next year and indeed the years after that.
Because they came out and said that, right? Even though $2.6 trillion in debt already, they're saying we're gonna need more.
They made those pledges to the electorate back in the spring. And what needs to be remembered in the context of Italy's politics is that this anti-European coalition government has support from the rich north and the poorer south. It's incredibly popular, and it would win another election if the vote were to be called today. So they have a lot of leverage from the domestic perspective that they can use with Brussels. And I think what they're banking on is that Brussels is going to be distracted by its own battles with Britain and Brexit, and therefore may allow Italy a little bit of room to slide on some of the budget targets. But that doesn't change the underlying fundamentals. It's a slowing economy, its demographics are moving in the wrong way, and its benchmark 10-year bond yields, and you're right to mention them, are at the highest level in 5 years. If they get up to 4%, Tracy, there's many analysts who say that the banking system cannot cope with it. They will be in an anti-liquidity position that they will not be able to continue to fund themselves. And that comes at a time when US dollar funding is starting to show stresses as a result of all of this money that's being borrowed by the US Treasury to pay for the Republican tax cuts.
So let's bring this all home. So between China and Italy, how does that bleed into the US economy?
That's a great question. The US economy is still streets ahead of everybody else, and those numerics are going to stay true between now and to the end of the year, I believe. We're probably going to see third quarter earnings grow at a 22% clip, and we'll have similar percentage gains, I would imagine, for the fourth quarter as well. GDP now forecast from the Atlanta Fed points to about a 4.1% GDP growth rate for the third quarter. Again, probably something similar in the fourth quarter as well. But the impact of tax cuts and of corporate earnings generation is going to fade into the first quarter of next year. And if that fades, as US Treasury yields are rising to take down all this debt, it's $230 billion worth of debt, which is being issued this week alone. $770 billion in the first half of this year, which is 60% more than last year. All of that money has to get taken down by the market. There is a corresponding rise in bond yields as a result. So if the economy begins to slow from the natural forces of the fade away of tax cuts, just as yields are going to rise, that could accelerate the downturn into the first and second quarter of next year. And that's when I think stocks are really going to be put under pressure.
All right, so you're going to have to stay tuned. Follow Martin, of course, on TheStreet, and we at TheStreet.com will be covering this wall to wall.